Hey, thank you for taking the time to click on today's video. I've been getting a lot of questions on my YouTube videos as well as my website, my Saturday morning radio show about life insurance, and I thought, why not do a really simple life insurance basics video? So if you've been curious about various different types of life insurance and what their uses are, today's video is for you. Now, we've broken this down into basically 3 different types of life insurance, but there's always some nuances in between. But before we get into this, I want to just kind of re-examine the reason why we need life insurance. So life insurance is something that obviously not all of us need, but early on in life insurance can be really useful because we've got obligations, we've got maybe a mortgage, we've got some young children at home, and if we died prematurely, all of that debt could be a major burden to our family. It could cause them to lose the home, automobiles, the business that we've worked so hard to build. It's a really useful thing. But there's another use for life insurance that I see later on in life that I think is missed so very often, and that is the fact that life insurance is a permission slip to be able to spend your retirement. When you think about it, we've worked really hard to build our retirement. We want to be able to enjoy and use our retirement, but oftentimes we kind of have this bit of a quandary in our mind about spending money because we want to leave a legacy. I committed many years ago to making certain that when I died, my children received as little pre-tax dollars as possible, because if I want to spend my money, I can, but if I do die, I want their legacy to be totally tax-free, and that's what life insurance death benefit is. It's a tax-free benefit to whoever receives it. So let's get into this. Life insurance really comes in 2 forms. It comes in temporary insurance, or it comes in permanent insurance. Now, temporary insurance is often referred to as term life insurance, and you'll see we've got basically 4 boxes, and there's a lot more. But let's say that this is a 5-year term, this is a 10-year term, this is a 20-year term, this is a 30-year term. Typically, insurance companies sell these in 5-year increments of 5, 10, 15, 20, 25, 30. You can pick whatever duration you want. And there's something that's pretty common among term life insurance policies. Number 1, the death benefit will remain level the entire term. And number 2, your premiums that you pay are going to remain level as well. That means that if you started the life insurance paying, say, $45 a month, it's going to remain $45 a month until the end of the term. Now, what happens at the end of the term? Well, what happens at the end of the term is that you're out of guarantee, and now the insurance company is going to jack up that premium, and they're going to say, oh, you can keep the life insurance if you'd like to, but it's now going to cost you very dearly. So we have to be careful to do one thing, and that is buy a longer duration of life insurance than what we think we may need, because I cannot tell you in the number of the last 2.5 decades of working with clients that I've seen regrets about, oh, I should have bought a longer term life insurance policy. Death benefit, maybe there could be some merit to buying more than what you need, but buying a longer duration than what you think you are going to need is always a good idea, because you can always shut it off, you can always turn it off whenever you want to. You have to be careful about term life insurance also, because life insurance, term life insurance, is now being sold in 2 different forms. First, it's being the traditional term, where at the end of the term, the insurance ends or you just simply leave. And if you're in a position where maybe your health has declined and you find yourself still needing the life insurance, you may be able to do something called a guaranteed convertibility. That means you're converting the term insurance to permanent insurance, and the insurance company cannot ask you health questions, they cannot make you go through underwriting, they have to give you the permanent policy. Now, you're going to be older, so therefore the cost is going to be higher, and it's permanent, so therefore the cost is going to be higher. But at least you're guaranteed to get the permanent life insurance, and you'll be able to continue on with the death benefit. Insurance companies have gotten clever, though, and they've developed what they call the permanent term. And this is where it's a permanent life insurance policy that has really low premiums for, say, the first 10, 15, 20 years. And then if you get to the end of the 20 years, all of a sudden your premium goes up and you're like, wait a minute, no, I don't want this. I want to continue on with this insurance. They're going to say, oh, yep, sorry, no guaranteed convertibility. You're already in a permanent life insurance policy. So if you want to continue, you have to continue paying those jacked up prices. So be very, very careful and specific about the type of term insurance that you have. The second life insurance policy, called a variable life insurance policy, this one I'm going to spend a bit of time on, because this this is marketed as a permanent life insurance policy, and theoretically it could be permanent. But why do we have these various lines? Well, the first thing is we have this straight line that's a dotted line. That's showing that the death benefit could run to 100, it could run to 110, 120 years of age. And don't tell me you don't think you're going to live that long, because you probably won't, but you definitely want to realize that we're living longer than ever before, so you want a life insurance policy that runs past 100. Number two, you see these jagged lines up and down. The reason I put those there is variable life insurance policies market these things as great accumulation tools. What happens is, as you're paying your premium and you're building up cash value, they're taking that cash value and they're investing it in mutual funds. Now, that can be marketed to you as a wonderful accumulation tool because the market can go up and you can make more money. The problem, though, is that the market is not a static place. It doesn't always go up. And so when we think about life insurance, as you age, as you get older, the cost internally of life insurance is going to go up. Your premiums might not, but the cost will go up. And as a result, if you're paying, say, $100 a month, but the cost is now $120 a month, you need to ask yourself, where's the extra $20 coming from? It's coming from the cash value. But if the market is declining, those mutual funds are losing value, they're going down, guess what? It can force a person to have a policy that runs out before they run out. And that is a major problem. So early on in life, I don't mind variable life insurance policies that much. They can be a good tool. But when the client starts reaching 55, 60, 65 years of age, that's when I pucker, because I realize they're going to be in a position where the market could correct on them. They could lose a tremendous amount of cash value. And then all of those premiums that they paid ends up being used up and the policy ends up dying before they do. Permanent life insurance. Now, the reason that this one's just a straight arrow is because it is a straight arrow. Permanent life insurance typically comes in three forms: traditional whole life that pays dividends, universal life that is interest sensitive, and indexed, which is based upon the market but does not actually cause you to lose money if the market goes down. Now, I'm just simply going to talk about the first two because indexed is pretty technical. So traditional whole life insurance is not as popular today. It is more expensive, but it has the ability of paying you dividends. And these dividends can be used to pay your premium. In other words, it's like having a neighbor help pay your bill for you. You can use those dividends, or you can pay those dividends directly to yourself and have a little extra income. That's kind of nice. Or you can use the dividends to buy what's called paid up additions. And what happens is, slowly over the course of time, the death benefit grows because the dividend is used to buy additional bits of insurance. Universal life has no dividends. It is interest bearing. Today's interest rates are extremely low, maybe 2%, so it's pretty paltry. But the reality is that the permanent universal life policies that are written today are designed to be mean and lean. They're designed to provide you a death benefit with very little cash accumulation, and they're very guarantee heavy. That means that if you start this policy and you know that the premium's going to be $100 a month or $300 a month, and you know that if you pay this $300 to the end of your life, this policy is guaranteed to run to 100, to 110, to 120, game over. It's going to continue to do what it says it's going to do because there's no moving parts. It's fully guaranteed. Remember, we don't want to develop and build a lot of cash value in permanent life insurance policies. I know it sounds really nice, and I know agents try to convince you, oh, this is a great accumulation tool. You can use this money to put your grandkids through college, or you can take it out and borrow it. And those things are all true, but I find that it doesn't really work out. What I want is I want a policy, and if I can do this, I want to die with 10 cents of cash value. Why? Because the life insurance company gets to keep your cash value. When you die, they get to keep your cash value. So I don't want a lot of cash value in my life insurance when I die. I want just enough to keep my policy going. And this is where it is very important that you work with a financial advisor who knows life insurance. They know what an in-force illustration is, which is like hooking your life insurance policy up to an EKG machine. It projects into the future for you, allows you to be able to see how your policy is performing today, how it's going to perform in the future. It is super, super important to do. And you need to do it about once every 3 to 5 years to make certain you're keeping a good check on your life insurance policy, making certain it's going to perform the way that you expected it to perform. Because remember, life insurance companies can change the internal cost of your insurance without you ever even knowing it, unless you know what to look for on your statement. So hopefully this has been a good basic rundown of life insurance. Remember, life insurance is good good to protect your family. Life insurance is good to be able to provide a tax-free legacy. Life insurance is a wonderful way as a permission slip to spend your own retirement so you can have a luxurious retirement, knowing that once you die, all of what you spent is going to be then replenished and provided to your spouse and to your kids and maybe even to your grandkids. So hopefully this has been helpful. If you like this little video, give us a thumbs up, share this with your friends, and if you like these videos, click on the subscribe button and hit that little bell and we'll notify you each and every time we have a weekly video. Thanks so much for watching, and remember, it's up to you to make today a great day.